The first domino has fallen. China's largest silver investment fund did not simply crash. Trading has been suspended. The doors are locked. The UBS SDIC Silver Futures Fund, representing China's primary pure-play silver investment vehicle, experienced suspensions exceeding 25 times between December and now. Authorities are not permitting exits. Authorities are not permitting entries. The market remains frozen. Mainstream sources claim suspensions resulted from price volatility. They claim regulators are protecting investors. This narrative is false. Internal documents exist. Premium data exists. Evidence demonstrates trading halts occurred because Chinese buyers were bidding 100% premiums for metal that does not exist physically. They paid equivalent rates of $150 per ounce, while global prices traded at $74. This was not panic selling. This represented panic buying so extreme it fractured the system. The system failure demonstrates global silver markets have broken into distinct pieces. China locked exits through export licensing on January 1st. Now they are locking entrances by suspending the singular fund enabling retail investor access. An arbitrage gap measuring $76 per ounce has emerged, exposing fundamental truth. Physical silver cannot move freely between markets anymore. Consider the timeline carefully. Early December 2025, unprecedented risk warnings begin. The UBS SDIC fund issues alerts to investors. The fund trades at 12% premium over net asset value, a record at that moment. Fund managers declare investors should cease purchasing due to elevated pricing. Investors accelerate instead. December 26th, subscription Class C closes entirely. Premiums exceed 60% above net asset value. The fund tracks silver futures theoretically, yet Chinese investors are paying 60% surcharges over actual holdings. Fund managers announce closure of share classes due to unsustainable premiums. January 22nd, 2026 represents the first complete suspension. Trading halts from opening to closing. Official explanations cite unsustainable premiums. But here emerges the critical question nobody addresses. If premiums are excessive, why not create additional fund units at net asset value and sell them at premium pricing? That represents standard fund operation. Arbitrage mechanisms would eliminate premiums through supply creation, yet this did not occur. They could not create units because underlying silver could not be sourced. January 28th, complete suspension of all subscriptions emerges. Regular automatic investment plans also cease. Premiums over Shanghai futures reach 36%. Fund managers issue statements declaring premiums unsustainable and speculative. Translation becomes clear. Participants are bidding silver exposure to levels implying physical metal is becoming unavailable imminently. January 30th, another complete suspension occurs. Market open through close remains halted. Premiums remain elevated. Simultaneously, global silver prices collapse from 120 to the 70s. Paper markets crash violently. Chinese investors continue paying massive premiums to gain access. The divergence becomes undeniable. February 2nd, nuclear option implementation. UBS SDIC announces valuation model changes. Shanghai Futures Exchange pricing replaces with major international silver futures markets, specifically COMEX. Results prove catastrophic. Net asset value collapses 31.5% in single trading day. This represents largest single-day Chinese public fund decline ever recorded, yet buried details matter. Before valuation changes, premiums exceeded 100%. Chinese investors paid double fund holdings based on Shanghai pricing. After forced revaluation to international pricing, fund NAV crashed because international prices were half of Shanghai implications. February 3rd, brief trading resumption occurs. The fund immediately hits limit down, a negative 10% circuit breaker halting trading. Limit down persists. Premiums remain 52.3% despite massive revaluation. Investors continue attempting purchases. February 5th through 6th, suspension from market open until 10:30 a.m. occurs. 4 consecutive limit down days follow. The fund experiences suspensions exceeding 25 instances in under 2 months. What does premium data actually signify? This represents the smoking gun proving shortage exists, not speculation. A 36% premium means if Shanghai futures silver trades at $100, the fund trades at $136. Investors pay 36% premiums exceeding underlying asset values. This already represents extreme conditions. Normal markets see 5 to 10% premiums immediately arbitraged. Somebody creates new fund units at $100 and sells at 136, capturing the difference. Premiums collapse through supply creation. This did not happen. Premiums reached 60%, then exceeded 100%. By early February, before forced revaluation, Chinese investors paid $150 equivalents when international spot prices approximated $75. This is not speculation, this is desperation. People understand physical silver supplies are running out. They will pay anything securing exposure before doors close completely. The fund could not create units meeting this demand because underlying silver could not be sourced. Instead of arbitraging premiums away, trading suspensions occurred. Official regulatory explanations cite investor protection from excessive premiums and speculative risks. This explanation fails logical examination. If protecting investors from overpaying exists as the goal, increasing supply becomes the mechanism. Fund units get created at net asset value, premiums collapse, everyone benefits. Instead, doors locked completely. Why? Because no underlying silver existed. Physical markets could not deliver. Rather than admit shortage, trading suspension prevented premium exposure. February 2nd brought unprecedented decisions. UBS SDIC announced valuation methodology switches from Shanghai futures exchange pricing to major international silver futures markets. In plain terminology, they stopped using Chinese prices. They started using COMEX prices. Results became the largest single-day net asset value collapse in Chinese public fund history. 31.5% vanished in one day. Fund management stated this became necessary for timely and fair underlying asset value reflection. Translation clarified. Shanghai silver pricing became artificially elevated because domestic markets could not access sufficient physical silver meeting demand. 17% daily Shanghai exchange price limits masked true international declines. Fund marking to international market prices exposed the gap. Chinese silver prices traded 30 to 45% above Western prices. That gap represents broken market functionality. In functioning global markets, arbitrage immediately closes gaps. Buy silver in New York at $74, ship to Shanghai, sell at $110 or $120, make substantial profits, gap closes. It did not close. Gaps persisted. Gaps widened. This tells something clear. Metal is stuck. Metal cannot flow freely from west to east. Regulatory announcements from December 30th, 2025 explain why. China implemented new export licensing systems for silver effective January 1st. This was not technically a ban. It was a licensing requirement. What it actually means becomes something else entirely. Only 44 companies received permission exporting silver from China during 2026 through 2027 periods. 44 licensed entities. Everyone else is locked out. China elevated silver from ordinary commodity to strategic material equivalent to rare earth elements. This was not announced prominently. No public relations campaigns occurred. Quietly, export restrictions took effect, trapping silver inside China's borders. Now examine the timeline. January 1st, export licensing takes effect. January 22nd, the Silver Fund begins suspending trading because premiums become unsustainable. January 28th, all subscriptions close. February 2nd, forced valuation reset causes 31.5% NAV collapse. Metal locked inside China through export restrictions. Chinese investors locked out of funds because sufficient metal could not be sourced meeting demand. Doors close on both sides. Coordination details prove this was not accident. Late January 2026, days before crashes commenced, Chinese billionaire trader Bian Shiming placed massive silver short bets, $300 million short. This same trader made fortunes on gold's record rallies. He understands market mechanics. He understands Chinese regulations. He positioned $300 million betting silver would crash precisely before fund suspensions began. He knew doors were closing. He knew systems were breaking. He positioned accordingly. Two market realities have emerged. Western prices approximate $74 to $79 per ounce currently. Chinese prices implied through fund premiums and Shanghai futures approximate $110 to $150 depending on metrics used. Arbitrage gaps measure 45.8% according to Shanghai Premium data. Dollar terms show $76 differences between New York silver purchases and Shanghai sales. Ideally, arbitrage closes gaps. Traders buy cheap, sell expensive, prices converge. That is how markets function. It is not functioning. Gaps are not closing. Shanghai Premiums hit plus 29% after February crashes. Current levels reach plus 45.8%. Gaps are widening, not narrowing. Why is arbitrage not functioning? Three fundamental reasons emerge. First, China's export licensing severely restricts inbound silver flows. Metal cannot simply ship into China through container transport and sell. Licenses are required, approvals are mandatory. Metal flows are throttled at borders. Second, physical silver is insufficient for closing large arbitrage gaps. Western vaults are being drained. COMEX registered inventories hit multi-year lows. Insufficient loose metal exists, arbitraging 45% gaps. Third, fund managers cannot create units even desiring to do so because underlying silver cannot be sourced. Physical markets are so constrained that funds managing hundreds of millions in silver exposure cannot obtain delivery. You observe the data clearly. Paper prices declined to $74 in Western markets. Chinese people pay $150 equivalent securing access. Funds shut down, preventing purchases. Does this characterize bear markets or shortages? Pause videos. Comment bear or shortage. I want reading your logic. If bear markets feature investors paying 100% premiums and regulators locking doors preventing buying frenzies, please explain. But historically examined bear markets show declining prices because participants lack demand. They do not show prices falling while investors bid closed-end funds to double their net asset values. Comment immediately. Physical inventory situations prove shortage becomes undeniable. Shanghai silver inventories hit 10-year lows in December 2025. December 2nd specifically, physical silver inventories on Shanghai futures exchanges plunged to over a decade lows. This is not normal. This is not temporary drawdown. This represents structural depletion. Simultaneously, COMEX registered inventories, metal available for futures contracts immediate delivery, drained at unprecedented rates. Early to mid-January 2026, over 7 days, 33.45 million ounces were physically withdrawn from COMEX vaults. That is 26% of registered inventory removed in single weeks. Combine Shanghai depletion with COMEX drainage, and both global silver market ends dry simultaneously. Eastern markets lack metal. Western markets bleed metal continuously. Arbitrage supposing system balance is not functioning because metal cannot flow freely. This is what system failures look like. Not crashes, but fractures. Markets split into two pieces, west and east, with $76 gaps that cannot close because physical metal is trapped. Global silver pricing becomes problematic, or more precisely, global paper prices increasingly disconnect from regional physical realities. COMEX prints contracts endlessly, but if Chinese buyers cannot access COMEX delivery and Shanghai inventories sit at decade lows and export restrictions prevent metal movement, then COMEX prices become screen numbers only. They do not reflect physical supply and demand. They reflect paper liquidation and margin calls. Regional pricing becomes real. The $150 equivalents Chinese investors paid before locking, that approaches true physical pricing in markets where supply is constrained and borders are closing. That is silver cost when dealers cannot be called for 2-week delivery. That is cost when warehouses are empty and exits are locked and entrances are locking. First, China locked exits through January 1st export licensing. Only 44 companies ship silver from China. Then they locked entrances by suspending the sole fund enabling retail investor access. Chinese citizens cannot easily purchase physical silver. They cannot freely invest in silver funds. Systematic lockout from markets is occurring. Why would governments implement this unless severe shortages are expected? Why trap metal inside borders and prevent citizen access unless that metal serves strategic purposes? Industrial production requirements, national reserve building, economic security needs? Patterns become clear. China hoards silver. Restrictions block exports. Financial access limitations emerge. Preparation occurs for a world where silver becomes scarce and strategically critical. This occurs while Western paper prices crash, providing cover for accumulation at lower prices before physical shortage becomes undeniable. What happens when March COMEX delivery periods arrive? Documented projections show 70 to 80 million ounce demand against 95 to 107 million ounce registered inventory. If half of demand stands for delivery, if contract holders demand metal rather than cash settlement, COMEX strains to unprecedented degrees. Do they deliver? Do they force cash settlements? Do rules change mid-game like nickel on London Metal Exchange in 2022 when short squeezes broke markets? Any outcomes further erode paper market confidence and accelerate migration toward physical and tokenized alternatives. What keeps analysts up at night? If China dumps $800 billion in U.S. Treasury holdings and buys physical commodities instead, in worlds of fractured trade relationships and potential sanctions, holding dollar paper becomes riskier than holding strategic physical resources. Commodity buying sprees could overwhelm global markets. Signals already emerge. Export restrictions on silver are part of broader patterns, including rare earths, tungsten, antimony, gallium. China systematically restricts materials critical to Western industries and defense. Leverage gets built, dependencies get created, physical materials get hoarded while West trades paper contracts. UBS SDIC fund suspension symptoms, larger shifts. It is not about investor protection from premiums. It is about preventing capital flight toward hard assets governments want controlling. It is managing perception of shortage when physical evidence screams shortage reality. Decade-low inventories, $76 arbitrage gaps, 100% premiums show shortage is real. One more evidence piece demonstrates physical shortage rather than speculation causes this. Funds issued risk warnings in early December when premiums were just 12%. 12% is elevated but manageable. Late December premiums hit 60%. Class C subscriptions closed. Late January premiums reached 100%, all trading suspended. If speculation alone drove this, fund managers would allow situations playing out. Speculators lose interest eventually. Premiums collapse. Markets self-correct. That is not what happened. Premiums kept growing. Buying pressure intensified. Fund management took increasingly drastic measures. Risk warnings first, then subscription closures, then trading suspensions, then forced revaluation resets preventing spiral. That is not speculation handling. That is bank run handling. That is responding when vault metal cannot back promised exposure, doors locked before people discover vaults are empty.